Welcome to our comprehensive guide on property, plant, and equipment, or PPE, under IAS16. In this video, we'll break down what PPE means, why it matters in accounting, and how it's recognized and measured in financial statements. Whether you're a student, a professional, or just curious about accounting standards, this series will help you understand the essentials of PPE, from initial recognition to depreciation and beyond. Let's start by exploring the definition and purpose of PPE, setting the foundation for everything that follows in this chapter. Property, plant, and equipment are tangible items held for use in the production or supply of goods and services, for rental to others, or for administrative purposes, and are expected to be used for more than one period. According to IAS16, these assets must have physical substance and provide economic benefits over time. Examples include land, buildings, machinery, vehicles, and furniture. Understanding this definition is crucial, as it determines which assets qualify as PPE and how they should be treated in your financial records. Next, we'll see how to distinguish PPE from other asset types. Not all assets are classified as PPE. For example, inventory, financial instruments, and intangible assets like websites are governed by different standards. Materials used in manufacturing are inventory under IAS2, while machines used in production are PPE under IAS16. Land held for investment falls under IAS40. It's important to apply the correct standard to each asset to ensure accurate reporting. This distinction helps organizations present a true and fair view of their financial position. Let's look at some practical examples to clarify these differences. For an item to be recognized as PPE, it must meet the asset definition and recognition criteria. It should be probable that future economic benefits will flow to the entity, and the cost can be measured reliably. This means you only record PPE when you have control over the asset, expect it to generate value, and can determine its cost. Both initial and subsequent costs must be evaluated against these criteria. This ensures that only relevant and faithfully represented assets appear on the balance sheet. Next, we'll discuss how to handle subsequent costs. After initial recognition, entities often incur additional costs on PPE. These could be for repairs, maintenance, or improvements. According to IAS16, only costs that increase the future economic benefits of the asset should be capitalized. Routine repairs and maintenance are expensed, while significant upgrades or replacements are added to the asset's carrying amount. For example, replacing a vehicle's oil is expensed, but installing a new navigation system that enhances its functionality is capitalized. This distinction helps maintain accurate asset values and expense recognition over time. When PPE is first recognized, it's measured at cost. This includes the purchase price, import duties, non-refundable taxes, and any directly attributable costs to bring the asset to its intended use. For example, delivery, installation, and testing costs are included, while administrative and training costs are not. If payment is deferred, the present value of future payments is used. In cases of asset exchange, the fair value of the asset given up is used for measurement. Understanding these rules ensures that PPE is accurately valued from the start. After initial recognition, PPE is measured using either the cost model or the revaluation model, applied consistently to each asset class. The cost model carries the asset at cost less accumulated depreciation and impairment. Depreciation systematically allocates the asset's depreciable amount over its useful life, reflecting the consumption of economic benefits. Methods include straight line, diminishing balance, and units of production. Depreciation begins when the asset is ready for use and stops only when it's derecognized. This process ensures expenses are matched with the periods benefiting from the asset. Let's look at how depreciation is calculated in practice. For instance, using the straight-line method, the depreciable amount is divided evenly over the asset's useful life. If a machine costs R1200000 with a residual value of R150000 and a 4-year useful life, annual depreciation is R262500. If the asset is used for only part of the year, depreciation is apportioned accordingly. Other methods, like diminishing balance and units of production, adjust the expense based on usage or remaining value. These examples illustrate how depreciation reflects asset consumption over time. It's important to review the useful lives and residual values of PPE annually, as these are estimates that may change with new information. If estimates change, depreciation is recalculated prospectively. Also, significant parts of an asset with different useful lives should be depreciated separately. Land and buildings must be accounted for individually, as land is not depreciated. By following these principles, organizations ensure accurate, transparent, and compliant financial reporting. Thanks for joining us on this journey through PPE and IAS16. Stay tuned for more accounting insights.